Angel investing and venture capital are two of the most important pillars in the startup ecosystem. They provide the critical funding that early-stage companies need to survive, develop their products, and enter the market. Let us begin with angel. Investing in angel investor is typically a high-net-worth individual who invests their personal money into startups. These investments often take place during the earliest stages of a company, sometimes even before the product is fully built. Investors usually come in when a startup has only an idea, a basic prototype, or a small team. They are often motivated by a mix of financial returns, personal interest, and the excitement of being part of something new. In return for their funding, angels usually receive equity ownership in the company. In many cases, they also act as advisors or mentors, offering their experience, industry knowledge, and connections to help the startup succeed. This personal touch is what often separates angel investing from institutional forms of funding. Now, let us talk about venture capital. Venture capital, or VC, is funding provided by firms that manage pooled investments from institutions, family offices, and wealthy individuals. Venture capitalists usually invest in startups that have already validated their idea through early users or initial revenue and are ready to scale. VCs tend to write bigger checks than angel investors and often lead formal funding rounds. These rounds are labeled as Series A, B, and so on depending on the stage of the company in exchange for their investment. VCs also take equity and sometimes require a seat on the board. Their goal is to guide the company toward rapid growth and eventually a profitable exit, such as an acquisition or an IPO. Spotting promising startups is both an art and a science. Experienced investors look for several key indicators. First is the founding team. Are they passionate, persistent, and skilled? Do they have a history of working well together and solving problems under pressure? Second is the product. Does it solve a real and painful problems? It different or better than existing solutions in a meaningful way? Third is the market. Is the potential market large enough to support long-term growth? Are there signs of demand, such as waiting lists, early customers, or strong user engagements? Fourth is traction. Even small wins, like user signups, revenue growth, or partnerships can show that the startup is on the right track. Finally, the investor considers the deal terms. This includes valuation, how much equity they will receive for their investment, and the overall risk-to-reward ratio. But despite the potential rewards, angel investing and venture capital are extremely risky. Statistics show that most startups fail within the first 5 years. This means that any money invested can be completely lost. To manage this risk, experienced investors build a portfolio of many startups that know that most will not succeed, but a few might become breakout successes. These rare winners often generate enough returns to make up for the losses and deliver overall profit. Timing also plays a crucial role. Getting in early on the next big thing can lead to exponential returns, but it also means investing when there is little data and high uncertainty. This is why due diligence, research, and sometimes gut instinct are so important at the early stage. It is not just about money, it is about vision, courage, and belief in people and ideas. Whether you are an angel or a venture capitalist, you are placing a bet on the future, and that bet can be both financially rewarding and deeply meaningful. You are helping to build companies that may one day change industries, create jobs, and shape the way we live and work.